Welcome to New Way Finance Academy. Today we delve into the world of finance, focusing on a topic that's critical to personal financial management: debt consolidation. As we navigate through the intricacies of money matters, understanding key financial terms becomes crucial. This video aims to demystify the concept of debt consolidation, making it digestible for everyone. Before we move on, kindly like this video, subscribe to New Way Finance Academy, and turn on notifications so you don't miss out on any of our informative content. To kick things off, we need to answer one question. What exactly is debt consolidation? Well, imagine you're juggling multiple balls at once. It's a bit like handling multiple debts. You have credit card debts, student loans, personal loans, all with different due dates, interest rates, and payment amounts. It can get overwhelming. Now, what if you could combine all those balls into one big ball? That's essentially what debt consolidation is. It's the process of combining multiple debts into a single one. Think of it this way. Instead of making multiple payments to several lenders, you make one payment to one lender. Sounds more manageable, right? But it's not just about convenience. Debt consolidation could also potentially lower your interest rates. Here's how. Let's say you have 3 credit cards, each with a high interest rate. If you consolidate these into one loan with a lower interest rate, you could save a significant amount in interest over time. The key here is that the interest rate on the new loan is less than the average interest rate on the existing debts. But remember, debt consolidation is not a one-size-fits-all solution. It depends on your individual financial situation. For some, it could be a game changer, simplifying their financial life and saving them money. For others, it may not make a significant difference, or could even lead to more debt if not managed properly. It's also important to note that while debt consolidation can make your debt more manageable and potentially save you money, it doesn't eliminate your debt. You're still responsible for paying off the total amount you owe. So why consider debt consolidation? Well, it can help streamline your debts, making them easier to manage. It can potentially lower your interest rates, saving you money. And it can give you a clearer picture of your debt situation, making it easier to create a plan to pay it off. So in essence, debt consolidation is a strategy used to streamline and manage debts more effectively. Now that we understand what debt consolidation is, the next question is, why should someone consider it? Well, the first and most apparent benefit is the convenience of single payment management. Instead of juggling multiple payments to different creditors each month, debt consolidation allows you to make one single payment. This can simplify your financial management and reduce the chances of missed or late payments. The second benefit is the potential for lower interest rates. Often, the interest rates on consolidated loans are lower than the combined interest rates on individual debts. This can result in significant savings over the life of the loan. However, it's important to note that this isn't always the case, and the interest rate will depend on factors such as your credit score and the terms of the consolidation loan. Another advantage of debt consolidation is that it can improve your credit score. When you consolidate your debts, you're effectively paying off multiple smaller debts. This can have a positive impact on your credit score, as it shows that you're taking proactive steps to manage and reduce your debt. But let's not forget that debt consolidation is not a one-size-fits-all solution. It might be the perfect solution for someone struggling with multiple high-interest credit card debts, but might not be the best option for someone with a single low-interest rate debt. It's also important to remember that debt consolidation doesn't erase debt. It merely restructures it, making it more manageable. And of course, there are potential downsides to consider. For instance, you could end up paying more in the long run if the term of your new loan is significantly longer than your original debts. Plus, if you're not disciplined with your spending, you could end up accumulating more debt. While debt consolidation has its advantages, remember, it's vital to assess your individual financial situation before making a decision. Understanding the benefits and potential pitfalls can help you make an informed choice that aligns with your financial goals. Now, let's explore how debt consolidation works. Debt consolidation is a financial strategy that combines multiple debts into a single, manageable loan. The journey begins with applying for a consolidation loan. This can be done through various financial institutions like banks, credit unions, or online lenders, who offer different types of consolidation loans, including personal loans, home equity loans, and credit card balance transfers. The goal is to secure a loan with a lower interest rate than your current debts. This way, you'll be paying less over the life of the loan. However, it's important to note that the interest rate you get largely depends on your credit score. A high credit score can help you secure a loan with a lower interest rate, while a low credit score might mean higher rates or even loan rejection. So it's crucial to maintain a good credit history. Once approved, the next step is to use the funds from the consolidation loan to pay off your multiple debts. This means your credit cards, student loans, medical bills, or any other outstanding debts are paid off, leaving you with just one loan to worry about. Now, instead of juggling multiple payments with varying interest rates, you only have one fixed monthly payment. This makes managing your debt easier and can help you pay off your debt faster. Plus, the lower interest rate means you'll be paying less overall. However, it's important to remember that debt consolidation doesn't erase your debt. It just simplifies it. You still have to make regular payments on your new loan. If you fail to do so, you could end up in a worse financial situation than before. So it's essential to create a realistic budget and stick to it. Debt consolidation, while simple in theory, requires careful planning and execution to be successful. It's not a quick fix, but a tool that, when used correctly, can help you regain control of your finances and work towards a debt-free future. There are several misconceptions about debt consolidation that we need to address. First off, a widely believed misconception is that debt consolidation reduces your actual debt. Let's clear this up. Debt consolidation does not reduce your debt. It simply combines multiple debts into a single one. The total amount you owe remains the same. It's just now you have one payment to make instead of several. It may lower your monthly payments, but that's often because the repayment period is extended, not because your debt is reduced. The second misconception is that debt consolidation is an instant solution to all debt problems. It might sound like a quick fix, but it's not. It's a tool that can help manage your debt, but it doesn't erase it. You still need to pay off what you owe. It can streamline your payments and possibly reduce your interest rates, but it requires discipline and a solid plan to pay off your debt in the long run. Lastly, there's a notion that debt consolidation is the only option to manage overwhelming debts. While it can be a viable strategy, it's not the only one. Other debt management options exist, such as debt settlement, bankruptcy, or even DIY methods like the snowball or avalanche strategies. Each has its own pros and cons, and it's important to understand these before deciding on the best course of action for your unique situation. It's essential to remember that debt consolidation is not a one-size-fits-all solution. It can be an effective tool for some, but it might not be the right choice for everyone. It's always best to consult with a financial advisor or conduct thorough research before making such a significant financial decision. Debunking these myths is crucial in making informed financial decisions. Remember, understanding is the first step towards effective financial management. So let's continue to shed light on these financial concepts and pave the way towards financial literacy and empowerment. As we wrap up our discussion on debt consolidation, it's important to note a few key points. Debt consolidation, as we've learned, is the process of combining multiple debts into one single payment. This can be a powerful tool for managing and reducing debt, but it's not a one-size-fits-all solution. The benefits are numerous. You may get lower interest rates, simplified payments, and potentially a faster route to being debt-free. However, it's essential to understand how it works to make the most out of it. Remember, it involves taking out a new loan to pay off your existing debts, which means you're not eliminating debt, but restructuring it. There are misconceptions that it's an easy fix or a cure-all for financial troubles, but it's not. It's a strategic move that requires careful consideration and understanding of your financial situation. Before making any decision, make sure to conduct a thorough individual financial analysis. Understand your debts, your income, and your ability to make payments. Remember, financial decisions require careful thought and planning. Stay financially savvy, and thank you for tuning in to New Way Finance Academy.